Hello, my friends. Today is October 21st. My name is Joseph, and this is Markets Weekly. Now, this week was another exciting week in global markets, so we have a lot to talk about. First and foremost, we have to talk about Treasury yields. This week, like many weeks before it, Treasury yields trended higher. The 10-year Treasury yield touched 5% before retracing, seemingly on account of geopolitical concerns. Now, many people are looking at this and wondering just when will it stop? Well, one way it could stop is if a very important actor like the Fed would put a stop to it. This week, we got some information on how the Fed is looking at this, and it seems like the Fed is blessing this rise in longer dated yields. Secondly, let's talk about the US households. So rates have gone up a lot, and we see a lot of doomer takes about how the US consumer and so forth are in dire straits. We have some good data from the Fed and from the big banks reporting the past week, and they seem to be sounding a very positive picture. Let's take a look as to what they're saying. And lastly, the Fed published their semi-annual financial stability report on Friday. Let's take a look as to what market participants report that they are concerned about and what the Fed staff are concerned about to see if there are anything lurking in the near term. Okay, starting with yields. So if you have been following my work for any amount of time, nothing that is happening in the markets should be surprising to you when it comes to yields. Yields are trending higher and they're going to go higher. So right now we have some geopolitical concerns in the Middle East, and you can see that playing out in gold, which popped notably on Friday. And yet, despite all these geopolitical concerns, we still see the 10-year yield around 4.9%. Now, I have no idea how politics would develop in the coming weeks, but if for whatever reason tension, let's say, tones down, you can imagine that that flight to safety bid gets unwound and can easily see the 10-year yield above 5%. Now, in thinking about just when will it top, one way I find useful is to think about just who could step in to kind of make this stop. And of course, the elephant in the room in these cases is always the Fed. If the Fed thought that the 10-year yield was going too high, that they didn't like what they were seeing, they could do something about it. It doesn't necessarily have to be asset purchases. They could go out and they just express concern or something like that and shift sentiment. So this past week, we got some information as to how the Fed is thinking about this. In one of the reports released from the Fed staff gave some commentary on 10-year on Treasury yields. So the Fed, of course, being schooled in standard economic thinking, when they look at longer dated Treasury yields, they decompose it into two segments. One segment is the expected path of policy, and the other segment is term premium. So for example, let's say the 10-year yield is at 5%. Now, you can think of that as, well, part of that is the expectation of where the path of interest rates set by the Fed in the next 10 years. Now, part of it is just a little bit of risk premia, a little bit of extra return that investors are asking for in order to hold longer dated yields. So by the Fed's calculation, they think that most of the increase, well, actually, basically all the increase in longer dated yields so far has been in term premia. Okay, so is the term premia really high or really low? Well, Fed staff, according to their calculations, they think that term premia is still historically very low. Now, this graph that they have here is as of September. And since September, now yields have gone up a bit. So term premium has widened a little bit, but you can see that historically, from this perspective, term premium is still historically low, and that suggests that the Fed is okay with this. But of course, that's just this perspective of Fed staff. We got to hear from the big man himself. Now, Jay Powell gave a talk this past week that was televised on YouTube, and we got to hear some of his thoughts. Well, first off, how is he looking at the rise in, let's say, the 10-year yield? he says that it's tightening financial conditions, which is kind of what monetary policy is supposed to do. Let's listen now.
There are those who suggested, including some colleagues in the Fed, that maybe the bond market is doing part of your job for you. Is that the way you see it?
Look, I would say it this way. The whole idea of tightening policy is to affect financial conditions. And to the extent higher bond rates reflect that they do, they're producing tighter financial conditions right now. So that's how monetary policy works. That's literally how it works.
Okay, so obviously we have the 10-year yield, let's say up 50 basis points in a month. That's going to tighten financial conditions. So if you are someone who wants to buy a home and you're trying to get a mortgage, your mortgage rates have gone up notably. If you're a corporation, you're trying to, let's say, borrow in the market, yes, the interest rates you have to borrow at are higher. So boom, tighten financial conditions. That's obvious. Now, but is that something concerning to Jay Powell? Are financial conditions getting too tight such that he might, try to push back against this relentless rise in longer dated yields? Let's listen.
So the evidence of your eyes is that the economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough. You're right, though, but we have models for everything. We have formulas for everything. Ultimately, as a practitioner, we have to be focused on what the economy is telling us, even taking lags into account. What's it telling us? Does it feel like policy is too tight right now? I would have to say no. I think the evidence is not that policy is too tight right now.
Well, it sounds like he's not really concerned, and maybe he's pretty happy that financial conditions are getting tight. After all, he's hiked rates to over 5%, and by all accounts, the economy continues to grow above trend. So from his perspective, financial conditions, haven't been super tight, maybe, and they're getting tighter. So it seems like things are going in a direction towards what he wants. So it seems like this move we see in longer dated yields has the Fed's blessing. Now, that being said, there are other actors that can try to push against this move, specifically the US Treasury, and I will write about that in my weekly blog post. Okay, the next topic I want to talk about is the condition of US households. So, as we all know, rates have gone up a lot, and how has that been affecting US households? Now, there are many people in social media who are talking about, there's tremendous pain and suffering, huge delinquencies, and so forth. But, those guys have been saying the same thing for 2 years, have been totally wrong, and are never going to get it. So, how do we go about looking at this? Well, let's look at the data. So, this past week, the Fed published 2 really interesting reports. One is the survey of consumer finances, something like that, which basically tells you about the income and net wealth of US households. And they also have the financial stability report, which we'll talk about more later, that has a section on US households. And on top of that, we also got the earnings releases of a lot of big banks. Now, big banks, millions of people bank with big banks. They are at the center of household financing. So they have a really good picture as to how the US consumer is doing. Now, the overall picture painted by all this data is that the US households are doing well. Now, income data, let's say over the past 3 years, from 2019 to 2022, we see median real income up a little bit, not too much. But what was really surprising to me about the survey of consumers from the Fed is that the median net worth of US households increased hugely just over the past few years. So US households are a lot wealthier today than they were a few years. And that wealth is largely due to the increase in home prices. So in the US, about 65% of the people own a home. And if you own a home, you've seen your home prices appreciate significantly, and home prices still are continuing to appreciate slightly. So overall, and yes, the rich people are even more richer. So this impact is largest along the wealthier spectrums, but even the median person is experiencing a significant appreciation in assets. Net worth is high. So incomes have risen over the past few years, and so real incomes have risen, and so have net worth. Now, what about how things are going today? So there's been a lot of talk about the rise in, let's say, auto loan delinquencies and the rise in credit card debt. Well, the Fed's financial stability report shows that, yes, absolutely right. Delinquencies in auto loans and credit cards has risen over the past few quarters. But if you look at the charts, you'll know that they've risen from very low levels and overall still remain within historical ranges. It doesn't look alarming at all. Now, the deterioration is going to be a bit more in the lower credit spectrum, but it always is. That's why they're low credits. Now, I also want to make a point to stress this. Oftentimes, I hear people talking about this significant rise in credit card debt. Now, consumer credit card debt has definitely risen, but you have to realize that's in nominal terms. Over the past few years, we've had an inflationary period. Incomes have risen, house prices have risen. Basically, all numbers have gone up. So when we look at credit card debt, we also have to normalize it a bit. Now, Jason Furman, great economist, has this really, really good graph that normalizes credit card debt by disposable income. And as you can see, once you do this calculation, the level of credit card debt is not at all alarming. There is nothing to be worried about. This is still actually on the lower end historically. Now, for some extra data, let's go to the big banks. Again, we got a lot of earnings releases from the big banks over the past 2 weeks. What are they seeing in the consumer space? Well, at JP Morgan, the biggest bank in the US, the CFO was asked this question, and the CFO basically said that I don't see consumer weakness, I don't see credit weakness anywhere. Okay, so JP Morgan, again, big bank, tons of data, has products everywhere throughout the country. They don't see credit weakness anywhere. Now let's look over at Bank of America, another big bank. Now, Bank of America actually provided a special graph just to show you where they think things are historically. And you can see from both their commercial data and their consumer data that losses are historically low and maybe normalizing a bit, but still low. Now, what about, let's say, their credit card data? Of course, they have good data on spending. Well, it has definitely been moderating, but it's not declining. So what they're showing here is that consumers continue to spend, but their spending, the spending growth is at levels that are basically around where things were before 2020. Spending is not declining as you would expect in a recession. It's just basically normalizing. Things are landing softly. So the big soft landing that many people doubted over the past 2 years really does seem to be actually happening according to a wide range of data. Now, that doesn't have to, that could change, but so far over the past few months, it doesn't seem like there's anything really concerning going forward. And I would also note that banks, they have to have loan loss provisions according to where they think, according to the losses that they expect to have. The big banks have actually notably lowered their loan loss provisions because they are not forecasting a recession anymore. So again, so far things look good. Okay. And the last thing we want to talk about is what was in the Fed's most recent financial stability report, where we can talk about potential risks to the economy and to the markets going forward. So let's first talk about what the Fed staff thought were concerning, and then we'll talk about what they found out when they surveyed a whole bunch of people. Now, across the financial stability report, it was honestly very mild. There was really nothing that jumped out to me. I think what was most notable that flagged by the Fed staff is equity valuations and commercial real estate valuations. So equity valuations. So if you're a traditional economist, the way that you look at this is you could compare equities to, say, quote unquote safe assets like US Treasuries. Now, this comparison is called the equity risk premium, which is basically, according to this metric, how much extra return you're getting by buying equities. Now, the equity risk premium, the yields have gone up a lot. And so the expectation is that you're not getting a whole lot of extra return by buying equities. So equities are, in that sense, historically, maybe a bit overvalued. The second way that you can look at this is to evaluate equities relative to their own history. So things like PE ratio. Let's say, this PE ratio high or low, historically speaking? Historically, it seems like it's relatively high. But when you look at these measures, though, what you always have to realize is that what is overvalued can continue to become overvalued, and what is cheap can continue to become very cheap. So if you are a classical macro guy, you're looking at this, yields going higher, then equities are rich. We got to sell equities, and maybe they're right. But there's also a lot of other things happening under the hood. Now, relationships in markets are always changing. So far, equities have been quite resilient. Now, I have no idea how things will go in the future, but I'm actually not bearish. And honestly, I'm getting the sense that there's a lot of people positioned for equities to tank, looking at yields. If equities don't tank, these people are going to have to cover, and they could squeeze the market higher, in my view. Now, the second thing that the Fed plugged is that they thought that commercial real estate is overvalued. And of course, it should be overvalued. If you look at cap rates, cap rates are really low relative to 10-year Treasury yields. So, you can get 5% buying a 10-year Treasury yield. Well, in cap rates, you can just get a little bit more from buying commercial real estate. Again, financial markets move very quickly, and so I guess the expectation would be for commercial real estate, a much slower moving market, to gradually adjust going forward. So at the moment, prices seem to be high. And traditionally, people think of that as a concern for banks, and it is, but I think first and foremost, it's a concern for the people who actually own the real estate. They have a lot of equity in it. It's after all their equity gets wiped out that it becomes a big problem for the bank. So first, let's think about all these big commercial real estate operators. And the last thing, of course, is that the Fed surveyed a whole bunch of people in the market to try to figure out just what they're worried about. Well, it seems like they're worried a lot about Fed tightening, and they're worried about slowdowns in China. Now, I don't actually put too much into these surveys because oftentimes, it's a portfolio manager or CEO or someone who just kind of looks at this and recalls whatever it is he is reading in the news. But just take it for as a reference. It seems like this is what people are thinking about. All right, that's all I've prepared for this week. If you like what I'm producing, remember to like it, subscribe. And if you are interested in hearing more about my thoughts on the markets, check out my blog, fedguide.com. And of course, if you're interested in learning about macro assets, check out my courses at centralbanking101.com. I'll talk to you guys next week.